So, you want to own an insurance company, a business model that, at first glance, looks like a massive prank, a glitch in the matrix of capitalism. You don't have to build sprawling gigafactories like Tesla. You don't need to burn mountains of cash on R&D like Apple, and you certainly don't have to drill through the Earth's crust in search of black gold like ExxonMobil. You only need to sell one thing: peace of mind, printed on a few flimsy sheets of A4 paper heavily packed with legal jargon so dense that nobody ever bothers to read it. But here is the most insane part of this industry. Customers obediently hand over hard, cold cash to you every single month, year after year. Yet, both you and the customer put your hands together and pray to God every night that they never actually have to use the product they just paid for. If you sell a car and the engine doesn't start, the customer will call a lawyer and drag you to court immediately. But if you sell insurance, and the customer never has to call in a claim, they breathe a sigh of relief because they are still alive or their house hasn't burned down. And you quietly pocket all that money. You are essentially commercializing fear and pricing human tragedy using probability algorithms detailed down to the decimal point. Your actuaries know exactly how much higher the percentage risk of a 35-year-old male smoker in Ohio crashing his car is compared to a middle-aged woman in Texas. Indeed, this American paradox has engineered one of the most terrifying vacuum cleaners of wealth in human history. In 2022 alone, the U.S. insurance industry swept up and raked in over $2.8 trillion USD in premium revenue, a figure that completely eclipses the combined GDP of many developed nations. However, the catch is that basic economic theory always preaches that high risk equals high reward. When a Category 5 hurricane sweeps across the Florida coast, washing away tens of thousands of roofs, or when apocalyptic wildfires incinerate entire affluent suburbs in California, common sense dictates that insurance companies should face a mountain of claims that drives them into bankruptcy. Massive payouts should theoretically drain their cash flow dry overnight. And yet, through some sort of financial dark magic, giants like State Farm, Allstate, or Progressive rarely collapse. On the contrary, they build lavish glass and steel skyscrapers in downtown Chicago, throw around cash to buy naming rights for colossal NFL stadiums, and hold the silent power to manipulate government legislation. Naive customers believe they are buying a protective shield, but the truth is, they are just unknowingly pumping blood into a ruthless, faceless financial empire, where the real rules of the game have absolutely nothing to do with the insurance policy itself. Do not let those touching television commercials featuring tearful family reunions or warm, sheltering hands fool you. The true nature of an insurance company is absolutely not a charitable organization dedicated to shouldering risks for society. To put it bluntly, when you take ownership of an insurance empire, you are running a completely legal hedge fund, brilliantly disguised under a cloak of civic welfare. And the ultimate weapon that helps Wall Street heavyweights turn this industry into an endless gold mine is encapsulated in a classic financial term: the float. Picture this. You collect auto insurance premiums from millions of drivers on the very first day of the month. This massive influx of hard, cold cash instantly flows directly into your bank accounts. However, accidents never happen all at once. A customer might obediently pay their premiums for 10 straight years before accidentally backing into a utility pole and filing a claim. So, where does all that money sit for a whole decade? Don't naively think it rests peacefully in a giant vault waiting to be returned to the victims. In reality, the insurance company's investment division takes this money they do not yet technically own, and throws it onto the betting tables of global financial markets. From pumping cash to acquire the most luxurious commercial real estate properties in Manhattan, hoarding U.S. Treasury bonds for safety, to pouring capital into notorious M&A deals orchestrated by private equity sharks. If a normal corporation needs capital to expand production, they have to knock on bank doors, beg for loans, or issue corporate bonds with exorbitant interest rates. But for an insurance company, not only do customers bring the money right to your doorstep for you to use freely, but they also voluntarily pay countless contract management fees. In absolute mathematical terms, you are accessing a massive pool of capital with a negative interest rate. People are literally paying you to take their money and invest it to generate profits for yourself. Nobody in this world understands and ruthlessly exploits this financial loophole better than the Oracle of Omaha himself, the highly respected billionaire Warren Buffett. The mainstream media often glorifies him as a kindly old man and a stock-picking genius, but the darkest and most powerful secret behind the trillion-dollar Berkshire Hathaway empire is, in fact, the insurance industry. When he successfully acquired the auto insurer Geico and later the reinsurance giant General Re, Buffett officially held the master key to capitalism. By the end of 2023, the scale of Berkshire Hathaway's float had swelled to an unfathomable figure: $164 billion USD. This is a colossal amount of free cash, an inexhaustible well that constantly regenerates every single day as millions of Americans renew their policies. Instead of taking on expensive debt from Wall Street, Buffett coldly used the exact funds from those hard-working drivers paying their monthly premiums to execute history-making acquisitions. He aggressively amassed shares in Apple, Coca-Cola, and American Express. The monumental profits and billion-dollar dividends from these corporations flowed directly into the pockets of Berkshire shareholders, while the payout costs for a few minor fender benders or burst pipes are mere grains of sand compared to the investment yields generated. Ultimately, the insurance company model is essentially a magnificent funnel. It vacuums up spare change and scrapes together savings from the working class, pooling them into an ocean of free capital to fund the billion-dollar gambles of the ultra-rich. Banish right now the naive thought that insurance companies survive and get rich by collecting more in premiums than they pay out in claims to customers. The brutal reality is that many giants in this industry intentionally take a loss on every single policy they sell. Sounds completely unbelievable, doesn't it? To understand this madness, you have to grasp Wall Street's ultimate mathematical weapon, the metric that determines the life or death of the entire empire: the combined ratio. Fundamentally, the combined ratio is the life or death yardstick of core underwriting performance. Its formula is incredibly simple. Take all incurred claims, losses, plus operating expenses, like broker commissions, employee salaries, advertising, and divide it by the total earned premiums. If this ratio is 100%, the company breaks even. They take in $100, they pay out exactly $100. If the ratio is 95%, they pocket $5 in direct underwriting profit. But look at the financial statements of the auto insurance behemoth State Farm in 2022. They recorded historic losses in their core underwriting operations, with their combined ratio skyrocketing to 111%. What does that mean? It means for every $100 they collected in premiums from customers, they had to dig into their pockets to pay out $111 to cover accidents and keep the machinery running. Doing the quick math, they took a brutal beating, losing over $13 billion USD in their property casualty division alone. According to the conventional logic of any normal business, a daily multi-billion-dollar hemorrhage like that would throw the board of directors straight into the arms of Chapter 11. For those who don't know, this is America's notorious bankruptcy code, the ultimate life raft where cash-strapped corporations file for court protection to dodge creditors, freeze debts, and bitterly liquidate assets. Yet, did State Farm collapse? Not at all. Indeed, they are still alive and kicking. Their balance sheet remains solid as a rock, and they still have plenty of spare cash to throw tens of millions of dollars at NFL superstar Patrick Mahomes for national TV commercials. The secret here is the operational mechanics of the miracle of negative interest. Let's flip back to the float card we just exposed earlier. When an insurance company accepts a combined ratio of 102%, meaning a 2% loss, it doesn't mean they are just setting money on fire. In reality, through the lens of financial masters, they are buying the right to use a massive float with a cost of capital of merely 2%. In the cutthroat financial world of America, where industrial corporations have to break their backs issuing junk bonds at extortionate 7%, 9% interest rates just to raise capital to survive the day, accessing tens of billions of dollars at a 2% cost is a privilege as cheap as dirt. Sometimes the combined ratio drops below 100%, which means customers are literally paying the insurance company negative interest to hold and invest their money. And this is where the real magic trick begins. The company's investment division casually takes that pile of unrealized claim money and hurls it straight into the stock market, bonds, or private equity funds. If their Wall Street team generates an average investment yield of around 6%, 8% annually, on a scale of hundreds of billions of dollars, that initial 2% underwriting loss is nothing more than a mosquito bite. You borrow money at 2%, invest it to make 8%, and comfortably pocket the massive invisible spread. Ultimately, this is the absolute mathematical advantage of the house. Insurance tycoons don't necessarily have to squeeze every last penny out of you at the claims negotiation table. They are even willing to quickly toss you a few bucks when your car gets a paint scratch, just to keep you hooked into renewing your contract next year. As long as that colossal river of cash keeps flowing relentlessly through their accounts, even if a storm washes away a few neighborhoods, the massive profits from cross-investment portfolios on Wall Street are more than enough to shoulder any losses. It transforms a business model that looks like it's bleeding money into a ruthless, unstoppable money-printing machine. If you open a casino in Las Vegas, you have to rack your brains designing windowless mazes, removing all the clocks, and constantly serving free drinks so players lose all concept of time. You call that the art of engineered immersion to retain customers. But if you own an insurance empire, you don't need to spend a single dime on those cheap psychological parlor tricks, because you have the most powerful bouncer on the planet forcing your customers to hand over their money every single month. The United States government and the Wall Street financial system. Just look at the reality. You want to drive your Toyota Camry to work every morning? Indeed, you have no choice. The law in 49 out of 50 states in America, with the eccentric exception of New Hampshire, explicitly states that driving without civil liability insurance is illegal. If you stubbornly break the law, traffic cops will write you thousands of dollars in tickets, suspend your license, or even impound your car entirely. State governments have unwittingly done the hardest part of the sales pitch for the insurance companies. Or taking it a step further, you want to get your hands on the traditional American dream, owning a suburban house with a lush green lawn? Unless you are a millionaire carrying a briefcase full of cash to buy it outright, the other 99% of Americans have to knock on the doors of banks like J.P. Morgan Chase, Wells Fargo, or government-backed entities like Fannie Mae to beg for a 30-year mortgage. And guess what the absolute prerequisite for funding is? That's right. You are mandated to present a homeowner's insurance policy. These banks are so terrified that you might skip out on your insurance bill that they set up something called an escrow account. Every single month, when you pay your mortgage principal and interest, the bank automatically deducts a portion of your money to pay the insurance company directly. You don't even get to hold that cash in your hands. This flawless financial structure traps you in a cycle with no way out. It is exactly this ruthless, mandatory immersion that creates a financial metric every other industry lusts after, an astronomical customer lifetime value, LTV. Once an American signs the contract, enters their credit card information, and turns on autopay, they will practically forget it even exists. Very few people have the free time to shop around, compare prices, and do the paperwork every single year to switch insurance companies just to save a few dozen bucks. The retention rate of major insurers consistently anchors at 85% to 90%. Customers will grit their teeth and continuously pump money into the system for 10, 20, or even 30 years straight. And that is the exact answer decoding a mystery that so many people wonder about. Why do insurance companies burn money so insanely on advertising? Geico is willing to throw around $1.5 billion USD every year just to repeatedly broadcast an animated gecko with a fake British accent. Progressive burns a similar figure to hype up their fictional employee character Flo, while State Farm blankets every major sporting event with Jake. They know perfectly well that the customer acquisition cost, CAC, can be expensive, easily hitting a few $100s for a new driver. But what does that matter? Once they catch you in their net, you become an obedient sheep being regularly milked for decades. That initial massive CAC is quickly recouped, and the entire steady stream of cash following it transforms into a lucrative, free source of float, flowing directly into Wall Street investment portfolios. Ultimately, the supreme power of an insurance company doesn't lie in their ability to sell a product well. It lies in the fact that they have succeeded in transforming their product from a voluntary purchase into a mandatory private tax, heavily enforced by the power of the state. At this point, you are probably wondering about a fatal flaw. Math and probability might work perfectly for daily fender benders or isolated minor kitchen fires. But what happens when a true black swan actually flaps its wings? Think back to 2005, when the Category 5 Hurricane Katrina swept across the Gulf of Mexico and completely submerged the city of New Orleans. Hundreds of thousands of homes were ripped apart, and countless businesses were turned into rubble in the blink of an eye. The total damages the insurance industry had to shoulder during that historic event reached a staggering figure, over $60 billion USD. More recently, the apocalyptic wildfires in California or the super typhoons making landfall in Florida have also wiped out tens of billions of dollars in just a few short nights. Logically speaking, a devastating financial shock like that is more than enough to wipe out entire cash reserves and push any retail insurance carrier to the grave. Yet, giants like Allstate and State Farm calmly weathered the storm, brushed the dust off their expensive suits, and proceeded to report profits the very next quarter. It is absolutely unbelievable. How do they do it? The answer lies in a cheat code, the ultimate trick of the house: reinsurance. In plain, everyday language, this is simply insurance for insurance companies. Picture it like this. When a retail insurance carrier collects $2,000 in annual home insurance premiums from you, they know full well that if your neighborhood gets washed away by a hurricane, they will have to dig into their pockets to pay you $500,000. To avoid the scenario of having to bear this tail risk alone, meaning rare catastrophes with highly destructive lethal force, your insurance company will pack a briefcase and knock on the doors of the true giants hiding in the shadows. These are the silent global financial powers holding absolute authority, reigning from tax havens or European financial hubs. Prime examples include Germany's Munich Re, Switzerland's Swiss Re, or the notorious reinsurance division of Berkshire Hathaway itself. Your insurance company will carve out a small portion of that $2,000 you just paid, let's say $400, and hand it directly to these reinsurers. In exchange, they sign a stop-loss protection treaty. This treaty explicitly states, if the total flood claim payouts in the state of Florida exceed the $1 billion USD threshold this year, every single expense past that first billion will be covered entirely by the reinsurance giants. This passing the ticking time bomb mechanism is terrifyingly flawless. Your local insurance company still retains the vast majority of the float to go surf investments on Wall Street, while simultaneously completely neutralizing the risk of bankruptcy. When the storm hits, they can generously sign compensation checks for you to get on the front page of the news, looking like a deeply caring, community-driven business. Meanwhile, the actual cash flow plugging that massive hole is being withdrawn straight from the treasuries of billion-dollar conglomerates all the way in Munich or Zurich. Indeed, this is a flawlessly stratified financial ecosystem. You pay money to transfer your risk to the retail insurance company. The retail company carves out money to push the catastrophe risk up to global reinsurance powers. And these global powers, with their hundreds of billions of dollars in cash mountains, continue to mold and chop up that risk, selling it off to hedge funds via a ruthless derivative instrument known as catastrophe bonds. Ultimately, catastrophic risk never truly disappears. It is merely packaged, diced up, and traded among the most hardened players on the planet. And the retail insurance companies in America? They are simply cunning toll collectors, sitting at the gates, eating the spread, and never having to face the music alone when doomsday actually comes knocking. To truly comprehend the ruthlessness and bottomless greed of this business model when pushed to its absolute limits, we must reopen the files of the bloodiest collapse in modern financial history, a story that, even today, remains the hardest stain to wash off American capitalism, the catastrophe of the AIG, American International Group, empire in 2008. In the early 2000s, AIG wasn't just a regular life or property insurance company. They were a genuine Goliath, reigning at the top of the global financial food chain with a flawless AAA credit rating. However, selling life insurance to the dead or collecting small change from car crashes gradually became too boring for the arrogant minds at the firm. In a small office in London, their financial products division, AGFP, AIG Financial Products, discovered an illegal feeling money printing machine, selling insurance to Wall Street. The merchandise they sold had a highly glamorous and complex name, Credit Default Swaps, CDS. In essence, these were nothing more than insurance policies for junk subprime mortgages bonds. The reality at the time was that banks, blinded by money, were handing out reckless loans to homebuyers with no income and no jobs. Then, they molded millions of these garbage loans into massive bond packages and sold them to investors. To reassure the buyers, Wall Street needed someone with enough prestige to step up and guarantee them, and AIG happily stepped forward. The rules of the game were incredibly simple. AIG told massive banks like Goldman Sachs or Morgan Stanley, "Just give us the premium fees. If those poor people default and can't pay their mortgages, we will compensate you for the entire loss of that bond." In just a few short years, the AGFP office, with fewer than 400 employees, issued a colossal volume of CDS insurance contracts totaling over $500 billion USD. The premium cash flow rushed in like a flood. Record profits were booked. The executives in London leisurely pocketed internal bonuses worth hundreds of millions of dollars to splurge on extravagant European vacations. But here is the fatal point of their greed. Unlike auto or life insurance, which are strictly heavily regulated by state governments regarding capital reserves, these CDS contracts were classified as OTC derivatives, operating completely off the radar of regulators. AIG issued hundreds of billions of dollars in insurance while setting aside virtually zero reserve funds. Because their genius algorithms firmly believed American real estate has gone up for 50 straight years. How could the entire U.S. market possibly collapse all at once? Indeed, arrogance breeds blindness. In 2008, the American housing bubble burst with the destructive force of an atomic bomb. Millions of Americans lost their jobs, tossed their keys, and abandoned their homes. The junk bonds evaporated in value overnight, and what had to happen, happened. Giants like Goldman Sachs and Société Générale, carrying mountains of CDS contracts, knocked on AIG's door, coldly demanding immediate insurance payouts to the tune of tens of billions of dollars. AIG was completely out of cash. The money printer broke down. They faced the death sentence of bankruptcy within a 48-hour window. At this moment, the entire global financial system held its breath in absolute panic. The tumor of AIG had rooted itself too deeply into the nervous system of capitalism. If AIG went bankrupt and defaulted, a massive chain of global banks would vanish with it. The stock market would be wiped out, and the pension funds of working-class Americans would turn to ash. The U.S. government was backed into a corner. With no other choice, the Federal Reserve, FED, and the U.S. Treasury had to grit their teeth, swallow their pride, and launch a historic bailout. They had to take the hard-earned tax dollars of citizens and throw it into a black hole named AIG, with the final bailout tally reaching an insane figure, $182 billion USD. This was money used by AIG to pay off its debts to those very Wall Street banks, helping those giants land safely. Ultimately, the AIG disaster laid bare the true rules of the elite. When you run an insurance business, if you guess right, you keep all the profits and buy the most expensive super yachts. But if you play recklessly, guess wrong, and shatter the system, don't worry. The government will force the poor taxpayers at the bottom of society to break their backs paying off your debts for you. Privatize the profits, socialize the losses. That is the perfect cruelty of Wall Street. Hearing the story about these endless gold mines in the previous chapters, your entrepreneurial blood is probably boiling. Indeed, you might be asking yourself, if exploiting the float is so lucrative, why don't I just raise a few $1,000,000, open an insurance company right now, and become the next Warren Buffett myself? The brutal reality is, you can't. This industry is surrounded by the most fortified and ruthless legal fortress walls in the entire American capitalist system. The heavyweights have rigged the rules of the game to ensure that no amateur can ever set foot inside their casino. You cannot start an insurance empire out of a rundown garage the way Steve Jobs built Apple. Every state in America has a Department of Insurance that rules with absolute life or death authority. For example, if you want to open a property insurance company in New York, the beating heart of the U.S. financial sector, the state law will immediately drop a sledgehammer on you. They require you to deposit a massive amount of statutory capital in pure cash or highly liquid assets. Depending on the scale, this figure can reach tens or even hundreds of millions of dollars from the very first day you open your doors, before you have even sold a single policy. Even if you try to flee to business-friendly havens like Delaware to exploit loopholes, the heavy burden of federal licensing costs, hiring exorbitantly expensive actuaries, and complying with thousands of pages of massive government regulations is more than enough to incinerate all your meager startup capital within a few short months. But let's just assume you are a bona fide millionaire and you make it past the state government checkpoints. You have tens of millions of dollars in cash reserves, and you hold every necessary license in your hand. Can you finally go out there and scoop up customers' money? The answer is still a cold, hard no, because at this point, you will crash into the true gatekeepers of this industry, the credit rating agencies, and a supreme power named AM Best. Remember how this machine operates. For a bank like Wells Fargo to approve a home mortgage, or for a construction contractor to buy your liability coverage, that insurance policy must be backed by a credit rating of A- or higher, issued by AM Best. Without this stamp of power, your product is nothing more than worthless scrap paper in the eyes of the U.S. financial system. Absolutely no one will dare entrust the safety of their assets to a no-name company. However, to catch the eye of AM Best and secure that Grade A certification, your company must prove a sustainable operating history spanning decades, possess flawless risk management models, and hold bottomless cash reserves that a new player can never build up on their own. It is a deadly chicken and egg loop. You need customers to build cash reserves, but you need cash reserves and a credit rating to get customers. Ultimately, the U.S. insurance industry is absolutely not a free startup playground or a fair competitive market. It is a closed oligopoly fortress, a billionaires' club exclusively reserved for the elite. With centuries-old roots, they have masterfully used political power, state laws, and credit standards to lock the doors from the inside, ensuring that this colossal trillion-dollar pie is forever carved up only among the old sharks of Wall Street. It is time we flip the final cards on this cutthroat financial chessboard. Let's say, by some miracle, you inherit a massive fortune, squeeze through the narrow gates of the U.S. legal system, and successfully acquire a compact property insurance carrier in a Midwestern state like Nebraska. How would your actual return on investment, ROI, picture play out? Let's look at the best-case scenario, where you play the game correctly according to the rules of Wall Street's visionary, yet ruthless heavyweights. You take over a company bringing in $50 million USD in annual premium revenue. Through sheer cunning in risk management and tactfully denying fraudulent claims, you maintain a flawless combined ratio of 99%. That means, from your core underwriting operations, you make a slight profit of 1%, just enough to pay your employees' salaries and office rent. However, the true magic lies in that invisible asset. Thanks to years of accumulation, you are sitting on a float amounting to $150 million USD. Your investment team casually tosses this customer money into safe bond portfolios and dividend-paying blue-chip stocks, bringing in a modest yield of 7% a year. Without needing to expand your market, without needing to invent a new iPhone or electric vehicle, you comfortably pocket $10.5 million USD in completely free investment interest every single year. Your return on equity, ROE, easily breaks out to the 15%, 20% range. You officially join the elite class, owning a perpetual capital-pumping machine that never runs dry. But every coin has its flip side. Greed often leads to destruction. Let's step into the worst-case scenario. Driven by an insatiable thirst to expand market share and gather more float, you order your actuaries to lower their standards, selling cheap policies to drivers with garbage driving records or homes scattered across wildfire-prone zones. As a result, your combined ratio skyrockets to 115%. At the exact same time, the stock market crashes in a dark shock, vaporizing 20% of the value in the investment portfolio you are holding. Even worse, America's toxic litigation culture starts coming for you. You get dragged into a multi-million-dollar class action lawsuit from customers accusing you of intentionally and illegally slashing their claim payouts. This double whammy loss from both the underwriting and investment sides will crush your statutory capital in just a few short quarters. State regulators will immediately raid your offices, seal your documents, revoke your operating licenses, and force you to liquidate whatever assets you have left to pay off debts. Your entire tens of millions of dollars empire turns to ash, and if you are unlucky enough to show signs of cooking the books, you could absolutely spend a few years doing time in a federal prison. Ultimately, after dissecting this entire empire, what do we see? The insurance industry is the purest, most sophisticated, and most ruthless embodiment of American capitalism. It creates absolutely no tangible material value, nor does it contribute any breakthrough technology to society. It does exactly one thing, and it does it better than anyone else. It uses cold mathematical models and the legal power of the state to collect a private tax from a fearful crowd. When you are an average citizen buying an insurance policy, you are desperately paying for an illusion of peace of mind. But when you are the one standing at the top of the pyramid holding ownership of an insurance company, you possess the ultimate privilege of manipulating the currency flow of the Wall Street gods. And those are the rules of the game. Welcome to the brutal reality of the ultra-rich. This is the wealth paradox. See you in the next Business Empire Breakdown.